Welcome to the Fed Life Podcast with Dan Sipe from Serving Those Who Serve. In this podcast, Dan draws from years of financial experience to help federal employees overcome challenges that every Fed can relate to. Join us for this journey as we reach, teach, and serve to help you make the right financial decisions. Now, on to the show.
Hello and welcome to this episode of the Fed Life Podcast. I am your host, Dan Sipe. Additionally, I'm the branch manager here at Serving Those Who Serve and Lee Sipe & Associates. Thank you for taking the time to listen, and thank you for your service. You simply do not hear that enough. We are back again with the guru, the incomparable, the amazing Ed Zerndorfer for part 2 of his explanation of the Federal Employee Group Life Insurance Program, or FEGLI. Ed is with us as part of our ongoing mission to reach, teach, and serve you. In this episode, Ed will guide us through FEGLI in retirement, designation of beneficiaries, claims, and more. And if you're listening and think, oh boy, I need to write this down, but I'm driving and I can't, have no fear. Ed's articles appear every month in the Fed Zone, and they will complement this. So there's text that you can download and read and enjoy at your leisure. You can access them at stwserve.com. As always, the opinions of Ed Zerndorfer, no matter how amazing, awesome, or exceptional they are his own and are provided for informational purposes only and should not be taken as advice. Please seek the guidance of your advisor or advisors before taking any action. We are back on FEGLI. Ed, welcome.
Thank you, Dan. It's nice to be back.
Okay, in our previous episode, you covered what FEGLI is, how we get FEGLI, how we keep it, how we change it. Now let's fast forward. Again, in this case, I'm a Fed, and I'm getting ready to retire. I have some choices and some decisions to make, right?
Correct.
Let's start with what I need to do to be eligible to continue my FEGLI in retirement. So I haven't used it, but I get married, because I remember from our earlier episode, I get married in the year before I retire, and I grab a whole bunch of FEGLI. Can I take it into retirement?
If you've only had it for 1 year, the answer is no. You have to have had it for 5 years. For 5 years preceding your retirement date. So you would have to work an additional 4 more years in order to keep the FEGLI for retirement.
Okay, so now let's say I'm the same guy. I have worked 5 years and I want to keep it. Let's start with basic life. Can I keep it? How do I do it?
So if you've had the FEGLI basic for the 5 years preceding your retirement date, then you have choices as far as how much of it you can keep throughout retirement. You really have 3 choices. Keep all of it, the entire amount that you had on the day of retirement. And I have to point out to you, Dan, it gets to be very expensive.
Okay.
I believe I mentioned in the previous podcast what you pay for FEGLI basic. I'll just repeat what I said then.
Please do.
When you are an employee, and it makes no difference what your age is, you could be 32 or be 82 years old if you're an employee. Each month, you're paying 32.5 cents per $1,000 of FEGLI basic coverage. 32.5 cents per $1,000 of FEGLI basic coverage. When you are retired, if you retire before 65, you will pay each month for the full amount of FEGLI basic coverage, $2.45.5 per $1,000 of coverage. That is almost a 900% increase in cost.
Okay.
If you retire after 65 or when you turn 65, the cost goes down to $2.13 per $1,000 of FEGLI basic insurance coverage per month.
So that's if I decide I want to keep it unreduced forever.
Forever.
One cost before 65, one cost after.
That's your first choice. Keep the full amount.
Okay.
Okay. The second choice is you can choose to reduce your FEGLI coverage by 75% of what you had on the day of retirement. So, for example, if you had $100,000 of FEGLI coverage on the day of retirement, FEGLI basic insurance amount, $100,000, and you want to go down to $25,000 of coverage, then the cost will be free starting when you're 65. If you have retired, or if you retire after 65, it's free from the start. They reduce, and the way the reduction works is starting the month after you're 65, if you retire before 65, or the month after you retire, if you retired after 65, the reduction is 2% of whatever you started with per month until it goes down to 25%. So that would take about approximately 37 to 38 months, about a little over 3 years to go down to 25%. So if your starting amount is $100,000 each month, you're going to have FEGLI coverage reduced, FEGLI basic amount reduced down by $2,000 a month until it goes down to $25,000. It is free at that point. There's no cost. When the reduction process is happening, it is free life insurance, and it stays free for the rest of the person in the retiree's life.
That's a nice perk.
It's a very nice perk because until it starts reducing, if somebody retired, let's say at age 60, they're paying 32.5 cents per $1,000 of coverage per month for the full amount of coverage, and that's the same amount they were paying when they were an employee. There's no increase in cost once they retire.
Wow. for
this perk. So this is a very, very good choice to have for FEGLI Basic. And the reason I say that is, in reality, Dan, most people do not need the full amount of FEGLI Basic once they retire. I say that because one of the reasons people have life insurance is to pay off a big debt like a mortgage. By the time they retire, the mortgage is paid off. One of the reasons people have FEGLI Basic, they have life insurance when they're working, is income protection for loved ones, like children.
Sure.
Well, now at this point, the children are on their own. They're independent. You don't need the life insurance for income protection. And the other reason that some people keep life insurance in retirement is to pay for funeral expenses or maybe some estate taxes. Well, the 25% reduction, the 75% reduction in the FEGLI Basic should be enough to pay for funeral expenses. Presumably, the individual has other assets like TSP and some other retirement accounts that they could use to pay for any funeral expenses or estate taxes.
You know, I'm glad to hear you again reiterate about that 75% reduction, or in my world, the 25% that you get to keep. Because again, I've been doing this 30 years. It breaks my heart when I encounter a Fed who's already retired and they just dropped everything because they didn't understand. They didn't understand they could pay the going rate until 65 and then it's free. Or they retire at 65 and somehow it gets mixed up that because it costs a certain amount to keep all the basic, that just letting the 75% reduction take place is actually a very good deal for them. Now, there's one in between the two, right?
There's the 50% reduction, Dan, in which an employee does pay an amount which is more than what they were paying when they were working before age 65. They're paying, I think it's $1.03 per $1,000 of coverage per month, and it's being reduced by 2% starting when they're 65. I'm sorry, 1%.
Okay, 1%.
Until it goes down to 50%. And then starting when they're 65, it's 71 cents per $1,000 of coverage until it goes down to 50%, but it stays that way. And the retiree is paying each month 71 cents per $1,000 of coverage for the rest of his or her life.
Okay. So Feds out there, one thing to keep in mind, if you get any information that says, oh, drop FEGLI right before you retire, don't do it. Don't do it without working your way through that.
I do want to point out, Dan, that if a person made the wrong decision, let's say they decided to keep 100% coverage in retirement, and then they go into retirement, discover, whoa, this is unaffordable. They can always reduce their FEGLI coverage. They can go from the 100% down to the 75% or go down to the 50%. They feel that they can't afford.
Oh, that's great.
They can make that choice. They can never increase, though. They never can join FEGLI, but they can always reduce the amount of their FEGLI basic once they retire. They can do that at any time.
When in doubt, folks, ask your advisor. Okay, how about the options? Let's start with option A. Our listeners will recall that's the flat $10,000. What happens to that when you retire?
The flat $10,000 will continue if the person decides to keep that in retirement, and there's really no reason not to. They'll pay until age 65, and the rate, I believe, is $6, $12 a month for a retiree until age 65.
Okay.
And when the retiree reaches 65, or if the employee retires after 65, it's free. There's no cost for option A. Why? Because that's also being reduced by 2% of the starting amount of which is $10,000. That's $200 a month until it goes down to $2,500 a month, and then it's free. There's no cost for option A once it's reduced and stays at $2,500.
Oh, okay. Free. So I've got that 25% residual there too. So that's pretty nice. Now, option B is not quite as generous in retirement, is it?
No, it's not, and it gets as we pointed out in the first podcast, that option B gets progressively more expensive as an individual gets older, particularly when they get into their 60s and 70s. An employee can make a choice to reduce the amount of their option B, reduce the multiples, so that there's less coverage. Also, there's the option of reducing it entirely till it goes down to nothing. And if they use that option, it'll also be free starting when they're 65.
Okay. All right. So now let's be fair, Ed. They don't increase the cost after age 80. So if you make it to 80 and you keep your option B, you're not going to get any increases at 85 for the moment. Now let's talk about option C.
Option C, again, that's for a spouse and for kids. But again, as I mentioned in the initial podcast, that option C for kids will stop when a child turns age 22. Mm-hmm. Presumably, when someone's retired, their kids are, unless they started having a family later in life, their kids will be over 22. There's no reason to have those kids, insured, and you might as well just remove them. And they should remove them as soon as possible.
Sure.
And if their spouse is still living, I'm sure the retiree would want to keep that life insurance on the spouse at the very least as a burial fund. And again, it depends on the age of the retiree, not the age of the spouse. So this is especially good if the retiree is younger than the spouse, because it's based on the retiree's age, not the spouse's age. So I would encourage keeping the option C for a spouse.
Okay. And now that will ratchet up in cost even in retirement, correct?
Yes, because it's based on the age of the retiree. As the retiree gets older, it gets more expensive.
Okay. All right. So that sort of tells us how it'll behave in retirement and what some of our choices are. Let's wade into some of the not so fun parts here, like beneficiaries and claims. Now, the program actually has a default setting for the payment of the claim, as well as the ability to designate the beneficiary of my choosing, correct? So if I don't do something, something happens. If I do designate something, it can happen the way I want it. Why don't you walk us through that?
Yes, Dan. I really encourage anybody who has FEGLI that they fill out the beneficiary form as soon as possible when they're first enrolled. And that beneficiary form is standard form SF 2823, designating the person or persons they want to have as beneficiaries of their FEGLI life insurance proceeds. That would include the FEGLI Basic, the FEGLI Option A, and Option B. That's who they would want to designate someone as beneficiary. And not only do they need to fill it out, but it has to be up to date. As personal circumstances change, for example, a person was married and then they got divorced, they had initially named their spouse as beneficiary. Well, that spouse has to be removed as beneficiary, and someone else has to be named in their place. It's not only in the case of divorce that the beneficiary form has to be updated. I ran across a case where an individual came into the government in 1972, fresh out of college, brand new, 22 years old, enrolled in FEGLI, and named his parents as beneficiary of FEGLI. And he subsequently got married, wife, three kids, never updated that beneficiary form. He died in 2004 with $600,000 of FEGLI life insurance proceeds, who went to his parents. Only problem is his parents were deceased. So what happened was that the estate had to be reopened. We're talking about legal costs, a delay. His wife and kids eventually got the FEGLI death proceeds, but at a price and at a big delay.
Ouch.
So you have to make sure that beneficiary form is filled out and up to date.
So let me ask you this, Ed. I mean, now let's say I'm a Fed, I'm 62 years old. I filled out that form 25 years ago. I can't remember if it's current, but what you're saying is my will won't change that. If my will says give it to my wife and my kids, FEGLI is going to have to follow what I wrote down 25 years ago.
That is correct. And I do want to point out that a will is not a substitute for a beneficiary form. So it's very important that federal employees who have FEGLI make sure that their beneficiary forms for FEGLI are up to date, current, and when in doubt, fill it out again.
When in doubt, fill it out. I like that. And it's funny, Ed, there actually was a case that made it all the way to the U.S. Supreme Court in 2013. And in this particular case, one state had a law in the books that said if you got divorced, your beneficiary designations were null and void. But the courts held that the beneficiary designation under FEGLI superseded state law. So in that particular case, it was paid to someone who would not have been the current beneficiary. So SF 2823, is that correct?
That's correct. That's the beneficiary form, SF 2823.
So that's something to keep up to date. Hear that, feds? Check your beneficiaries. When in doubt, fill it out. So my will can't affect a beneficiary designation. What about a court order?
A court order can affect the beneficiary designation in terms of the person is forced to give life insurance proceeds to, let's say, a spouse, an ex-spouse, or whatever other reason there's there, like for pay child support, whatever. There are circumstances where it can be superseding that beneficiary's designation.
Okay. Now I know because I read your articles, and they're always awesome. In there, you talked about something called order of precedence, and one of the terms that was in there is something called assignment. What does that mean relative to FEGLI, and why is that important?
Assignment means that a FEGLI owner, someone who has an employee who has a FEGLI life insurance, assigns the policy to somebody else who's technically the owner, and the owner now is responsible for naming a beneficiary. If they want to keep the same beneficiary, they can, but they can change it. Now, why would somebody want to assign their FEGLI life insurance? The only reason I can think of at this point is that they want to get the FEGLI life insurance out of their estate.
Okay.
Life insurance proceeds when paid out, are not subject to federal income taxes or state income taxes. However, FEGLI life insurance proceeds, like other life insurance proceeds, are part of one's gross estate.
That's true.
And they could be subject to federal and state estate taxes.
Okay.
Now, this was not a problem. This is really not much of a problem in this day and age because the federal estate tax will kick in when a person's estate is over $11.8 million.
Okay.
I can't think of too many people who have an estate in this area or other areas that I go to that have an estate over $11.8 million.
But for the folks that aspire to.
but just beware. Now, that's on the federal level. There are some states in which the states have their own estate taxes. There are some states that have an estate tax exemption of only, let's say, $675,000. It doesn't take much to come up with an estate of $675,000. If you include your house, I know some people who have TSB account that's over $1 million right there, and then their life insurance will kick them way over that exemption amount. And if they die, their estate would be subject to federal estate taxes, state estate taxes. But by getting the FEGLI out of their estate by having somebody else own the policy, then it would not be part of their gross estate.
Interesting point. So number one, make sure you know the laws in the state where you reside. And number two, as always, check with your advisor. Before we dig into claims, Ed, can I get you to cover the living benefits provision on BASIC again? Because I just think that's so important.
Okay. The FEGLI Basic, and I believe option A also has, it's a standard. They have it both. That if a FEGLI owner, if an employee or a retiree is enrolled in the FEGLI Basic and has, let's say, and they have option A, if that individual was diagnosed with a terminal disease, has a life expectancy of less than 9 months, then that individual would be allowed to tap into their FEGLI Basic and option A, tax-free, to pay for anything, whether it's a medical procedure, to pay for drugs, to pay off their mortgage, to give a gift to their children, and they're going to use that FEGLI in any way they want and not have to worry about paying taxes on it. Now, the question I've gotten so often is about this accelerated death benefit rider. I actually get a couple questions. Do I pay for that? And the answer is no. Under FEGLI, you don't pay anything extra for that rider. But the other question is, Ed, suppose I beat the odds and I don't die within the 9 months and I used up all my FEGLI. Will I, in fact, have to pay tax on the money I took out of my life insurance policy? Because it is a taxable event. Normally, if you tap into your life insurance to pay to use that money for anything, you're going to pay tax. And if you're under 59 and a half, a 10% early withdrawal penalty. And the answer is, I'm happy to report the IRS is very happy that you lived. They will not come and tax you on the fact that you did not die within the 9-month period. Of course, your life insurance policy is now up. Now you don't have any more life insurance.
Yeah, but I'm alive.
I think I'm pretty happy about that. The thing is, you're still living.
And further, as I touched on before, in my practice, I have seen where people have been able to use these living benefits for expanded treatment, experimental treatments, things like that. So again, feds, please, if you're listening to this, remember it. If you learn of someone in your agency, friends, family, whatever, who might be covered under this, let them know, because to not know about it is almost the same as not having it. So last but certainly not least, I have FEGLI, and I'm going on to the great beyond. What do my beneficiaries or personal representatives need to do?
Upon your death, a claim form has to be filed together with a death certificate. I think the claim form is Form F, F as in Frank, E as in Edward, -6. Has to be filed with the Office of FEGLI together with a beneficiary, with a death certificate, certified death certificate, and each beneficiary has to file his or her own claim.
Good point. So if I have a bunch of kids, they each need to submit a form if they're all beneficiaries.
That is correct.
Okay. Ed, you are indeed a walking, talking database of federal benefits information. But seriously, I'm so grateful that you keep coming on, and our feds are truly lucky to have you. Will you come back?
Absolutely.
Okay, then I'll come back too. That's it for us. The topics on our podcast are for informational purposes only and should not be taken as advice. The opinions of our guests are their own and not necessarily those of Serving Those Who Serve, FedLife, or Raymond James. Interesting dates and tidbits quoted by me can be found in the Federal Register in entries spanning 1954 to 2013. We are Serving Those Who Serve. We are here to reach, teach, and serve you. Be sure to subscribe to our podcast on our YouTube channel and remember to share it with friends and strangers. Check us out on Twitter and LinkedIn. Don't forget our seminars every month in 4 convenient locations around the District, Maryland, and Virginia, featuring the incomparable, the amazing, the guru, Ed Zerndorfer. Ed Live really is an experience you don't want to miss. So for more information, go to stwserve.com and click Seminars and Events. Be sure to read Ed every month in the Fed Zone, also at stwserve.com. So for Ed, the crew at Serving Those Who Serve, and me, Dan Sipe, good luck, Godspeed, and above all, remember, it's your Fed life. Make it a great one, because you deserve it. We are out.
Thank you for listening to the Fed Life Podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Serving Those Who Serve or Raymond James. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Securities offered through Raymond James Financial Services Incorporated, member FINRA SIPC. Investment advisory services offered through Raymond James Financial Services Advisors Incorporated. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services.
Neither Raymond James Financial Services nor any Raymond James financial advisor renders advice on tax issues. These matters should be discussed with the appropriate professional. Investing involves risk, and you may incur a profit or loss regardless of strategy selected, including diversification and asset allocation. Raymond James is not affiliated with and does not endorse the opinions or services of the quoted professionals or their respective organizations.